Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Rivian reported earnings after the market closed on Tuesday, and it was kind of a mixed bag for investors. They increased production guidance from 50,000 to 52,000, not a big increase, and I think we had seen estimates that might be significantly higher than that. The company is also continuing to burn a ton of cash, but there is progress on getting towards break even for some of its vehicles. So I want to go through some of the most important numbers and what I took from the results and from the conference call. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. If you enjoy this video, check out my newsletter, Asymmetric Investing. I got a link to that in the show notes. And I'll start here with just some of the highlights. We know that there was a 50% production increase versus Q1 2023. We knew those production numbers from July. Those were reported earlier. The dual motor has been added to the R1 lineup, and there's been a significant increase in the gross loss per vehicle. I think this is always a little bit confusing when management says something like this, a $35,000 gross profit improvement. They're still losing money on every vehicle they produce. They're just losing less money than they were a quarter ago. There are a number of reasons for that. There were some cost reductions. When you scale operations, you're now taking your fixed costs and dividing those across many more vehicles. So this isn't all that surprising number, but definitely something that management was highlighting. And here's that production increase to 52,000. So a nice little increase from 50,000, which was the earlier guidance. Adjusted EBITDA, which is going to be a proxy for cash flow from the operations, negative $4.2 billion for 2023. Keep that in mind because I think that's going to be important as we go into next year. And then CapEx guidance reduced to $1.7 billion. That was not because of major changes, but actually just timing of when some of those capital expenditures were going to happen. Now, a couple of signs of improvement that are worth going over. On the gross margin side, you can see that revenue is going up pretty sharply. That's what you would expect as deliveries increase. Gross profit is improving. This is what management was talking about there, $704 million in a gross loss a year ago, and that was down to a $412 million gross loss. So Rivian is losing a little over $32,000 per vehicle or a negative 37% margin. So this is an improvement, obviously a big improvement from just a quarter ago. This is that $35,000 difference that management is talking about, but they're still losing a lot of money on each vehicle. R&D and SG&A expenses are coming down, especially from a year ago. Some of that means that some of that is some of those costs going to production, and some of that is actual cost reductions. There was actually layoffs that happened at Rivian. So there is some cost coming down on the operating side, but we do see here free cash flow was negative $1.6 billion. So still a lot of cash being burned, and cash and short-term investments at $10.2 billion. That is including the debt that the company has taken out over the past couple of years. So this isn't a debt-free company that has $10.2 billion in cash on the balance sheet. That cash is there in part because debt has been taken out. And here's one of the challenges for growing a business like this. Not only is Rivian losing money on every vehicle that's produced, they're having to build out their production, and even their next production facility in Georgia, that's going to cost, currently reported to be $5 billion, and that's going to have to come off the balance sheet. So you have all of this cash being burned from operations, you have the expense to build out that new facility, and inventory is typically a drag on the balance sheet as you're growing as a company. Management has said this, that deliveries are not going to be as high as production because you have a lag between when a vehicle is produced and when it's actually delivered to a customer. But over that period of time, Rivian has to hold that vehicle on its balance sheet before it gets that cash. Building inventory for a product company is actually very costly. Over the last 6 months, $1.2 billion in additional inventory is now on the balance sheet. That's going to continue to go up because it's not just finished goods, it's raw materials, it's work in progress goods. There's a lot of inventory that goes into building vehicles, a lot of costs that goes into Rivian's production that needs to be considered by investors, because as quickly as things are improving, I don't think there's enough cash for Rivian to get to break even and build that Georgia facility that they really need to get to profitability. The other thing I took from the conference call, this is just a quick quote. Their CFO said that during the 2024 shutdown, they're going to get the R1 line to 85,000 units per year, do it through a number of different upgrades. Now, we don't know exactly what the production of R1 versus the EDV delivery van is, but this would indicate that production is still only going to be around 100,000 units on a run rate basis in 2024. So again, Rivian is going to continue growing, but they're also probably going to burn a significant amount of cash, not only this year, but next year as well. These are steps in the right direction for Rivian, but there's still a lot of questions ahead. I think R1 demand is something we really need to question. Management said that 70% of R1 vehicles produced in the quarter were the R1S. There's actually plenty of demand for the R1S right now, but the R1T you can actually get delivered within a few weeks. So the fact that only 30% of production was the R1T and there's not enough backlog to move deliveries into 2024 indicates that demand may actually be a problem for R1T. We don't know what R1S sits at. Seems like that's doing much better. But these small little anecdotes we need to read into because Rivian is trying to grow their production at an extremely rapid pace and is now building another facility in Georgia. So I think there's plenty of steps in the right direction, but this is by no means a guaranteed win for Rivian. And now that we don't know what backlog looks like, it's even more uncertain what kind of pricing power they're going to have, what sort of margins they're going to have. I sold my Rivian stock a few weeks ago. I continue to sit on the sidelines because I think the EV space is going to go through a rough transition over the next couple of years, but we'll see how this plays out. Rivian is definitely taking steps in the right direction. It's got a lot of cash on the balance sheet. The question is, does it have enough cash to get to profitability? We will find out over the next few years. But what do you think of the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.